Hi, welcome to my channel, Second PUC Accountancy. Learn, understand, and excel. Today, we are going to see another sum under admission of a partner where the goodwill is brought in cash and it is withdrawn. In the previous class, we had seen half goodwill withdrawn. In this class, we are going to see full goodwill withdrawn by the old partners. So now, let us see the question here. The question given here is Anita and Vanita are partners in a firm sharing profits and losses in the ratio of 3:2. Their balance sheet as on 31st March 2024 was as follows. This is the balance sheet given here. Now we'll see the liabilities. On the liabilities side, creditors is 20,000, bills payable is rupees 6,000, reserve fund is rupees 4,000, and capitals of Anita is 40,000 and Vanita is at 30,000. So the total capital of the old firm is rupees 70,000. Now on the asset side, we have cash in hand, that is 5,000, debtors 20,000 less PDD rupees 2,000. So the balance debtors is 18,000. Next we have stock as 17,000, buildings as 35,000 and furniture as 25,000. First, let's see the balance sheet entries, how and where it has to be recorded. Now see the creditors. Creditors will go to the new balance sheet. Bills payable also will go to the new balance sheet. Reserve fund will go to the partners' capital account. That is, it should be distributed to the old partners in their old profit sharing ratio. Next, capitals will be the opening balance of the capital account of Anita and Vanita. Now moving on to the asset side, cash in hand will go to the new balance sheet but along with certain adjustments. Then debtors also will go to the new balance sheet with the adjustment. Then stock will go to new balance sheet, buildings will go to new balance sheet, and furniture also will go to new balance sheet along with the adjustments. Now let's see the adjustments given here. On 1st April 2024, Sunita is admitted into the partnership on the following terms. So what are the terms and conditions given here? First, Sunita brings in rupees 25,000 as capital. First, Sunita brings in rupees 25,000 as capital and rupees 10,000 towards goodwill for 1/6 share in the future profits. And this goodwill amount, rupees 10,000, should be withdrawn by the old partners. Since they have not mentioned anything in the adjustment, we assume that the full goodwill is withdrawn by the old partners and it has to be treated as per AS 26. Now moving on to the second adjustment, it says depreciate furniture at 10% and appreciate buildings by 20%. The third adjustment is provision for doubtful debts is no longer required. So we'll see how to treat this. Now next adjustment is provide rupees 1,000 for repair charges. With this information, we have to prepare revaluation account, partners capital account, and the balance sheet of the new firm after admission. So first let's see what is given here and how to treat the adjustments. Now see here, the first adjustment says that Anita and Vanita old ratios given here. That is 3:2, which can be written as 3/5 and 2/5. And Sunita, the new partner's ratio is given as 1/6. So here, since the goodwill treatment has to be made under AS 26, we need sacrifice ratio to distribute the goodwill which is brought in by the new partner. So the sacrifice ratio will be 3:2. That is same as the old ratio since there is no other information given to us about the new profit sharing ratio. So it will be 3/5 and 2/5 in which the goodwill will be distributed to the old partners. Now moving on to the adjustments given here. The first adjustment says that the new partner Sunita brings in 25,000 as capital and 10,000 towards goodwill. So here Sunita brings capital rupees 25,000 and goodwill rupees 10,000. So the total cash which is brought in by the new partner is rupees 35,000, which should be recorded as a cash account as in the balance sheet it is given as cash in hand. So here the steps to be followed are: first, the total cash rupees 35,000 will be credited to Sunita's capital account. That is the total capital which is brought in by Sunita. So under his account we have to write as by cash rupees 35,000. And the second step is to treat the goodwill. The goodwill amount is rupees 10,000. So that is brought in by the new partner Sunita to be distributed to the old partners Anita and Vanita. So this will be distributed to them in their sacrifice ratio, that is 3:2. So it will be for Anita's share in goodwill will be 3 by 5 into 10,000 will be 6,000, and for Vanita's share in goodwill will be 2 by 5 into 10,000, that is 4,000. So this should be distributed to the old partners on the credit side of partners capital account. And then the total of the cash should be recorded in the balance sheet. Note the amount of cash that has to be shown in the balance sheet. So take the opening balance, what is given in the old balance sheet, 5,000. To that, we have to add the capital that is brought in by Sunita, that is 25,000, and add the goodwill which is brought in by Sunita, rupees 10,000. So total cash which comes in is 40,000. So full goodwill is withdrawn by Anita and Vanita. So that full goodwill of rupees 10,000 should be deducted from this cash. So the remaining cash that should be recorded in the balance sheet will be rupees 30,000. That will be the closing of cash balance in the balance sheet. Now moving on to the next adjustment, that is the depreciation of furniture. The depreciation of furniture is at 10%. So depreciation should be calculated on the furniture rupees 25,000 into 10 by 100, which will be 2,500. Now this is a decrease in the value of furniture. So the treatment for that will be: first we have to record it on the debit side of revaluation account, and secondly in the balance sheet we have to deduct it from the furniture on the asset side. So this is the treatment for furniture. Next we will move on to the continuation of that adjustment, that is appreciate buildings by 20%. Appreciation is the increase in the value of asset building at 20%. So building value is 35,000 into 20%, 20 by 100 will be 7,000 rupees increase in the value of building. So therefore the treatment is that on the revaluation account it will appear on the credit side, and in the balance sheet it should be added to the building as the value of the building is increasing. Now moving on to the next important adjustment, that is with regard to PDD. It says that PDD or the doubtful debts is no longer required. There is a PDD which is given in the balance sheet. Now it says in the adjustment that this PDD is no longer required. So therefore note here that this PDD which is no longer required it is treated as a recovered amount. So it is no longer a bad debt for the firm. So therefore this PDD in the old balance sheet rupees 2,000 is now treated as amount recovered as it is a asset increased. So since the asset is increasing, first we will record it in the revaluation account credit side rupees 2,000, and when we have to record in the balance sheet the entire amount of debtors 20,000 will be recorded in the balance sheet and no PDD will be deducted. Therefore the entire amount of 20,000 should be recorded in the balance sheet on the asset side. Moving on to the next adjustment, that is repair charges rupees 1,000. This is outstanding expenses, so therefore it will appear in the revaluation account debit side, and in the balance sheet it will be recorded as a liability. So it is the amount which is to be paid by the firm. So it is increase of liability, so it will be recorded on the liability side of the balance sheet. Now let us see how to prepare the revaluation account. So this is the format of the revaluation account. So here, first, as per the adjustments given, we have furniture that is depreciated. So it will appear on the debit side. Furniture will come on the debit side. To furniture, that is 25,000 into 10%, 2,500. And next, we have the appreciation of the buildings. So if this appreciation is increase of an asset, it will appear on the credit side of revaluation account as buy buildings, that is 35,000 into 20 by 100, 7,000 on the credit side. Next we have is provision for doubtful debts, which is no longer required. It is a recovered amount. So this also is a increase of asset. So it will be recorded on the credit side of revaluation account by PDD. The entire PDD which is given in the balance sheet, the old PDD, should be recorded on the credit side of revaluation account. Next we have is the provision for repair charges. So it is an increase of liability. So it will appear on the debit side of revaluation account to provision for repair charges rupees 1,000. Now once these have been recorded, the total we have to check here. The total, if you see here, credit side is more 9,000. So that should be recorded on both the sides, 9,000. And deduct the debit side total, that is 3,500. We will get revaluation profit. Since credit side is more, it is revaluation profit. Debit side of the revaluation account to profit transferred to Anita's capital account and Vanita's capital account. So the balance amount is 5,500. Now this 5,500 should be distributed to Anita and Vanita in their old profit sharing ratio. So 5,500 into 3 by 5 will be 3,300 for Anita, and 5,500 into 2 by 5 will be 2,200 for Vanita. So this is the revaluation profit which should be transferred to the partner's capital account. So this is the revaluation account. Next, we will move on to see the next account, that is the partner's capital account. So we have three partners here, Anita, Vanita and Sunita on the debit side, and again on the credit side, Anita, Vanita and Sunita. So now in the partner's capital account, first we need to bring down the opening balance, that is the capital from the balance sheet of the old partners. So it will be recorded on the credit side as by balance brought down, that is the capital given in the balance sheet, 40,000 for Anita and 30,000 for Vanita. Now after this, we have to bring down the reserve which is given in the balance sheet. It is the reserve which is created by the old partners. So bring down to the partners, old partners in their old profit sharing ratio, that is 4,000 rupees should be divided to the old partners in the ratio of 3:2. So it will be 4,000 into 3 by 5, 2,400 for Anita, and 4,000 into 2 by 5, 1,600 for Vanita. Now there is a revaluation profit which we had calculated in the previous account. So revaluation profit should be again distributed to the old partners. So it is a revaluation profit from the revaluation account which we had already distributed. So 3,300 for Anita and 2,200 for Vanita. Now next what we have to do is now moving on to the new partner. Now new partner Sunita brings in the capital as well as the goodwill. So it is the cash which is coming into the firm by Sunita. So it should be recorded on the credit side as by cash account, and this is brought in by Sunita capital and goodwill. So that is 25,000 plus 10,000 under Sunita's account. Under Sunita's column, it is 35,000. So this is the cash which is brought in by the new partner. Now this, under this 10,000 rupees is the goodwill. Now this goodwill is brought in by the new partner for the old partners for the sacrifice. So this 10,000 goodwill should be distributed to the old partners in the sacrifice ratio. So from Sunita's account, we have to distribute it to the old partners Anita and Vanita. It will be recorded on the credit side by Sunita's capital account, that is the goodwill amount 10,000 should be distributed to the old partners in the ratio of 3 is to 2. So 10,000 into 3 by 5, 6,000 will be given to Anita, and 10,000 into 2 by 5, 4,000 will be given to Vanita. Now since we are taking it from the new partner Sunita's account, his amount, capital amount will decrease. So we have to reduce that amount, showing the entry on the debit side. So here Sunita is giving to Anita, it will appear on the debit side. To Anita's capital account, goodwill is given by Sunita 6,000. So 6,000 rupees we are deducting from Sunita's account, and also it is given to Vanita, written on the debit side as to Vanita's capital account. Goodwill amount which is given by Sunita is 4,000. So we are deducting 10,000 from Sunita's account. Now, next what happens is here the old partners are withdrawing this goodwill. So they are fully withdrawing the goodwill amount. When they withdraw, the cash is going out, and therefore it is considered as a drawings. So it will appear on the debit side as to cash account, the goodwill amount which is withdrawn. It is fully withdrawn. So whatever amount is given to the old partners as goodwill from Sunita should be fully withdrawn or debited to the partners' capital account. That is Anita and Vanita's capital account. So 6,000 is withdrawn by Anita and 4,000 is withdrawn by Vanita. So now with all the entries done, we need to find the balance. So first get the totals. So for Anita, it will be 51,700. So it's the credit side is higher. So write the same total on both the sides, 51,700. And for Vanita, 37,800. Again, the credit side is greater. So write on both the sides 37,800. And for Sunita, it is 35,000. Credit side is more. So write on both the sides 35,000. So now find the balance. The debit side is lesser. So deduct 51,700 minus 6,000 for Anita, and 37,800 subtract 4,000 for Vanita, and 35,000 minus 10,000 for Sunita. So therefore the balance here will be written on the debit side to balance carried down. For Anita, it is 45,700. For Vanita, it is 33,800. And for Sunita, it is 25,000. So this balance should be brought on for the next period. So we have to bring it down, which will be the opening balance for the next year. And this will be the new capital which has to be transferred to the balance sheet. That is the new balance sheet with all the three partners including the new partner. So bring down this to the next period, that is by balance brought down for all the three partners to show that it is the opening balance for the next year. So now let us see the preparation of balance sheet. Now the balance sheet should be prepared as at 1st April 2024. So here the first entry will be on the asset side, the cash. The cash need to be adjusted as the cash is brought in by the new partner Sunita, capital and goodwill. So cash will appear on the asset side, cash in hand. So we have to add the cash which was given in the balance sheet plus Sunita's capital plus Sunita's goodwill, and we have to deduct the full goodwill which was withdrawn by the old partners. So which will be 5,000 plus 25,000 plus 10,000 minus the goodwill 10,000, the full goodwill which has been withdrawn. So the balance cash which will appear in the balance sheet will be rupees 30,000. Now next what we have is on the balance sheet is the debtors. Now debtors, we had an adjustment saying that the PDD is no longer required. So the PDD should not be taken into account. Write the original debtors amount, that is 20,000. So since the PDD is recovered, the PDD will not be deducted in the balance sheet. Now moving on to the next adjustment, that is the stock. Now for stock there's no adjustment, so we are going to bring down the stock on the asset side, stock 17,000. Next we have is the buildings. Now buildings are being appreciated, so show it on the asset side. Buildings 35,000 and the appreciation 7,000. So total value of the buildings is 42,000, which will appear on the asset side. The next item what we have is the furniture. The furniture again here it is depreciated. So furniture 25,000 less depreciation 2,500. So after depreciating the furniture the amount is 22,500 on the asset side. So now these are the entries which are given on the asset side of the balance sheet. So we have entered along with the adjustments. Now moving on to the entries on the liability side, we have first creditors. There is no adjustment related to creditors. Just bring down the creditors 20,000 on the liability side. Next, we have bills payable. Bring down bills payable since no adjustment, write it as it is, 6,000 on the liability side of the balance sheet. Now, next we have to bring down the new capital of the new firm of Anita, Vanita, and Sunita. So bring down the capitals of all the three partners. So for Anita, it is 45,700. Vanita 33,800 and Sunita 25,000. So the total new capital is 1,04,500. Now the next one last adjustment which is left in the adjustments given in the question, that is provision for repair charges. Since it is the liability, write it on the liability side, provision for repair charges 1,000. So now all the assets and the liabilities are done. Now find the total. The assets equal to the liabilities. The total of liability is 1,31,500. So on the asset side again 1,31,500. So this is the total of the balance sheet. So we have completed the sum under goodwill which is withdrawn, which is fully withdrawn by the partners. So let's see another important sum in the next video with a different goodwill adjustment. Thank you.